Today, we are digging into a really fascinating analysis report on the precious metals sector. And the main thesis is pretty bold. It says the silver supercycle isn't on its way, it's here right now. The report really zeroes in on one specific company, Core Mining Inc. That's ticker CDE. Trading this morning right around $19.19. We need to figure out why the analysts are saying CDE is the best way to play this.
That's exactly it. And look, we're not just talking about a temporary price spike here. Our mission in this deep dive is to really unpack the structural forces, the macro pressures, and the company specifics that this report claims make this a huge moment for CDE. And we have to understand why they've given it this title, the king of leverage.
I like that framing, a super cycle. So let's start at the very top. If you haven't been watching the markets, you might have missed this, but spot silver just shattered $75 an ounce this week.
Yeah, an all-time high.
That's more than a record. It feels like a historic benchmark for the whole sector.
And what's really interesting is how the analysts are framing this $75 print. They're not seeing it as just, momentum. They're calling it evidence of a permanent structural deficit in the silver market.
A structural deficit. So they think the floor has permanently moved higher.
That's the argument. That for the foreseeable future, the fundamental baseline for silver prices is just higher, even with some volatility.
Okay, so structural deficit means something's happening on both supply and demand. What are the big catalysts this analysis report points to? What's creating this perfect storm?
It's two massive drivers hitting at the same time. First, you've got the monetary driver. The classic one, it's really anticipatory. The Federal Reserve has been signaling rate cuts for 2026.
Right, lower interest rates.
Exactly. And historically, that weakens the dollar, which makes non-yielding assets like silver and gold way more attractive. All that institutional money starts flowing out of low-yield bonds and into hard assets.
That's the traditional play. But the story for silver feels so much more explosive this time around.
Because of the second driver.
Oh, absolutely. The industrial driver is, I think, the most compelling part of this whole story. Silver is just critical for conductivity. And the research note points to huge demand from new tech.
We're talking AI chips, solar panels.
AI chips, the global solar panel build-out, EVs, you name it. That demand has been outstripping the global mine supply for 4 years straight.
Wow, 4 years running hotter than supply. That's a huge deal.
It is.
So you have a monetary environment pushing people to buy and an industrial environment that's literally consuming all the available supply.
Yeah.
That really is a structural deficit.
Precisely. And you can see it reflected in investor sentiment. The analysis highlights that retail sentiment is, well, it's through the roof. 57% of investors are now targeting $100 an ounce for silver by 2026. Okay, $100 an ounce. Let me play devil's advocate for a moment. If you're that bullish on silver, why bother with a single mining stock like CDE? Why not just buy a silver ETF and keep it simple? This has to get us to that king of leverage idea.
It's a critical point, and it really gets to the mechanics of mining. If you buy the physical metal, or an ETF that holds it, you get a one-to-one return. Silver goes up 33%, from 75 to 100. You make 33%.
Makes sense.
But a miner gives you leveraged exposure. It's all about their fixed operating costs.
Can you just break down how that leverage works for our listeners?
Sure. Think of it like this. Let's say it costs a company $15 to get 1 ounce of silver out of the ground.
Okay.
That cost is pretty stable. So when silver was trading at $30, their profit margin was $15 an ounce. Simple enough.
Right.
But now, with silver at $75, their profit margin is $60 an ounce. The metal price only doubled, but their margin just quadrupled.
A fourfold increase in profit.
Exactly.
Yeah.
And if silver hits that $100 target, the profit expansion is exponential. That's how you see a stock jump 3 times or 5 times more than the commodity itself. That's the leverage.
That perfectly clarifies the shift from commodity to miner. Okay, so now we have to transition from the macro picture to Core mining specifically. Why does this report single out CDE?
Well, the report is very clear on this. It's not a generic play. CDE is chosen because of its unique operational turning points. First off, it's a premier North American producer. They're sitting on a huge pile of domestic silver reserves.
Which insulates them from geopolitical risk. That's a huge deal for big investors right now.
A very big deal. But the core of the story, the thing the analysis kept coming back to, was the company's engine room, the Rochester mine in Nevada.
Ah, yes, Rochester.
The report calls it the holy grail of mining. It's the key to everything. For years, as you know, Rochester was just a massive capital expense, a black hole for cash.
I remember the pain. It felt like they were just pouring money into that expansion forever. It really kept the stock price down. So what's the evidence that the pain is finally over, that the turnaround is real?
The evidence is in the metrics. The CapEx phase is officially history. The report says Rochester is now fully ramped up and has turned into a cash machine. And you rarely see these things line up so perfectly. Volume is up 30% year over year.
For 80%.
And this is the critical part. Their costs are dropping at the same time because of new efficiencies.
So it's the perfect storm in a good way. Higher production, lower costs, and record silver prices.
The triple threat, that's how the leverage we just talked about gets maximized.
Yeah.
Profitability doesn't just go up, it expands exponentially. And this directly impacts their financials, specifically their free cash flow.
And just to remind everyone, free cash flow, or FCF, is the money left over after a company pays for everything. All operations, all necessary growth projects. It's the pure profit.
Correct. It's the money they can use to pay down debt, buy back stock, you name it. The analysts are arguing this massive FCF generation from Rochester is forcing Wall Street to give CDE a higher valuation multiple. They're finally being priced on performance, not just potential.
Okay, and this is where it gets even more interesting because CDE isn't just standing still. They're making a huge corporate move. They're in the final stages of acquiring New Gold.
This feels bigger than just a simple purchase.
It's much bigger. The research note calls it a transformation, and that's the right word. The New Gold deal instantly creates a premier, diversified producer based entirely in North America. It pulls them out of being just a pure-play silver stock.
But does adding that diversification dilute the silver leverage thesis we've been talking about?
According to these sources, no. It actually de-risks the whole investment. That's what attracts the big institutional funds that can't invest in single commodity companies. They get scale and stability, but they still keep that massive silver exposure through Rochester. It's a brilliant strategic fit. And when those big funds start looking, they look at the big financial numbers. What's the key combined metric they provided?
The projected combined EBITDA, that's earnings before interest, taxes, depreciation, and amortization, is forecast to be over $3 billion in 2026.
$3 billion.
$3 billion. That is a complete game changer. It elevates CDE into a whole new league of miners.
So let's sum up the fundamental case here. You've got the macro tailwind from the silver deficit.
You've got the company catalyst with Rochester turning into a cash machine.
And the portfolio-changing catalyst of the New Gold merger. It all really reinforces that king of leverage nickname.
It absolutely does. The fundamental setup is just incredibly robust.
Right.
But, in these fast-moving markets, you also have to look to the technicals. What is the report telling us about the stock's price action?
The technicals are always key for timing. And the analysis identifies a really clear, rock-solid support level for CDE at $18. That's the floor.
And that floor is important because we just saw the stock break out cleanly above $19 on really heavy volume.
Right, which suggests institutional buying.
Exactly. And right now, the stock is being described as flagging right under the psychological $20 level. A classic continuation setup.
That $20 mark is always such a big mental hurdle, isn't it? A magnet. So what's the Wall Street consensus here, and why isn't the stock already higher?
The consensus is very positive. The latest figures are 6 buys and 2 strong buys from the big banks. But the really smart insight from the report is this concept they call the lag effect.
The lag effect. Tell us about that. I think a lot of people who follow these markets will recognize this.
It's basically Wall Street playing catch-up. Their financial models and price targets were built for a world with much lower silver prices. Now that silver just hit an all-time high, the analysts are all scrambling to plug that new $75 price and the huge FCF from Rochester into their spreadsheets.
So the report is saying the stock price hasn't actually caught up to the new reality. The official upgrades haven't even been published yet.
That's it. There's latent buying pressure, just waiting. The stock is cheap compared to where the new numbers suggest it should be trading.
Okay, so let's get to it. What are the price targets from this source material?
The immediate near-term target is $25. And that target is specifically tied to the next big catalyst, which is the upcoming merger vote for New Gold. That event should provide the momentum.
And looking at the chart, once that big psychological $20 level finally breaks, what's above it?
The note is very clear on this. Once 20 is breached, there's very little overhead resistance until the stock challenges its 52-week high, which is $23.62. $25 becomes a very reachable target.
That sets up the conclusion perfectly. So if we tie all of this together, the macro, Rochester, the merger, what's the final verdict for you, the listener?
Zooming out, the conclusion from the analyst is that CDE is just this uniquely perfect vehicle for this market. The combination of the macro tailwinds and these huge company-specific wins puts it in a class of its own. It's not a generic ETF. It's not another miner. It's different.
And the final verdict from the source material is pretty direct strategy. Aggressive buy. They state very clearly that if you believe silver is going to $100 an ounce, then CDE at $19 is basically a gift. It's priced before the rest of the market has woken up.
And that really is the heart of it. So the final provocative thought we want to leave you with, the one the report really urges you to focus on, is this. Watch that critical $20 resistance point next week. What happens when the stock breaks that level? If it clears 20 with conviction on heavy volume, the report's final words are, "We fly." That's the signal.